Hello everyone, my name is Dr. Parul Gaba and I am an assistant professor at Tecnia Institute of Advanced Studies. Today I will discuss with you the topic cost and its types. Let's delve into the topic together. Let's begin with a simple thought. Imagine you want to start a small cafe. To price your food and earn a profit, wouldn't you want to know how much you are spending to prepare each dish? That is where the concept of cost becomes important. In business, cost accounting is not just a matter of calculating expenses. It is a strategic tool to make smarter decisions. Cost accounting focuses on capturing all the costs involved in producing goods or services to help managers plan, control, and improve operations. Before learning how to control cost, it is essential to understand what exactly cost means and the different types that exist. Now coming on to the meaning and definition of cost. The term cost simply refers to the amount of money spent on acquiring something. In accounting terms, cost refers to the monetary value of all the resources used in the production of goods or delivery of services. This includes raw materials, labor, utilities, rent, and other overheads. According to the Institute of Cost and Management Accountants, cost is defined as the amount of expenditure, actual or notional, incurred on or attributable to a specified thing or activity. In other words, cost can be actual money spent or a value assigned to a resource even if no direct payment has been made, as long as it helps to determine the value of a product or services. Now, types of cost. Cost can be classified in several ways depending on the nature, function, behavior, traceability, and purpose. Let's now elaborate on each classification type along with relatable examples. First, classification based on elements or nature. This is the most basic form of classification where cost is broken down into three components. Material cost. It refers to the cost of all raw materials and components used in the production process. These are tangible items like wood, fabric, plastic, or flour depending on the product. For example, in a bakery, the material cost will include ingredients like flour, sugar, eggs, and butter. Labor cost. It includes the wages and salary paid to the workers involved in manufacturing or delivering the service. This can either be direct labor like factory workers or indirect labor like maintenance staff. In furniture business, the payment made to carpenters for crafting tables is a direct labor cost. Other expenses cover all other costs which are neither material nor labor but are essential for production or support. This may include electricity, rent, machine, depreciation, insurance, or licensing. These are often grouped as overhead in cost accounting. Second, classification based on function. This classification is based on the purpose or function for which the cost is incurred within an organization. Production or manufacturing cost is the total cost of making a product. It includes raw materials, labor, and factory overheads. For instance, the total cost of manufacturing a mobile phone would include the cost of its components, assembly labor, and electricity used in the factory. Administrative cost refers to the expenses involved in managing and running the organization. These are not directly tied to the production process. Examples include the salary of HR staff, stationery used in the office, and the telephone expenses. Selling and distribution cost includes cost related to the marketing, advertising, packaging, transportation, and delivery of the product to customers. A real-life example is a logistic company spending on fuel, drivers, wages, and vehicle maintenance to deliver online orders. Third is classification based on behavior. In this method, costs are categorized by how they behave with respect to changes in production or business activity. Fixed costs remain unchanged irrespective of the level of output or sales. Whether a company produces 10 units or 1000 units, these costs stay constant. Rent of the factory, building, or salaries of permanent staff are common examples of fixed cost. Now, variable cost, these are those costs that change in direct proportion to the level of production. The more you produce, the higher the cost. For example, if each unit of a soft drink bottle requires rupees 5 worth of ingredients, producing 1000 bottles will cost rupees 5000, while 2000 bottles will cost rupees 10,000. Semi-variable cost, also known as mixed cost, contain both fixed and variable elements. A typical example is your electricity bill, where there is a fixed charge regardless of usage and a variable charge depending on how much electricity is consumed. These costs increases with output but not in direct proportion. Classification based on traceability to product. These classification considered whether a cost can be directly linked to a specific product or service. Direct costs are those that can be traced specifically to a particular product, job, or process. These includes raw material and direct labor. For instance, the leather used in making a pair of shoes is a direct cost to that product. Indirect costs are those that cannot be directly attributed to any one product and are instead shared across multiple products or departments. Examples include the salary of a factory supervisor or the depreciation on a general machinery used for all the products. Next is classification for decision making. Some costs are useful primarily for managerial decision making. These may or may not be recorded in books but are crucial for analysis. Opportunity cost refers to the value of the next best alternative that is foregone when a choice is made. For example, if an entrepreneur leaves a rupees 50,000 per month job to start a business, that rupees 50,000 is the opportunity cost of running the business. Sunk cost is a cost that has already been incurred and cannot be recovered. It should not affect future business decisions. For example, money spent on a marketing campaign that didn't generate any leads is a sunk cost. Marginal cost is the additional cost incurred in producing one more unit of a product. If producing 100 shirt costs rupees 10,000 and producing 101 shirt cost 10,100 rupees, then the marginal cost of the 101 shirt is rupees 100. Standard cost is a predetermined cost for products or operations, usually used for budgeting and performance evaluation. It represents what the cost should be under normal conditions. Imputed cost refers to a cost that does not involve any cash outflow but is considered in decision making. For example, when the owner uses their own building for the business without charging rent, the notional rent is an imputed cost. Next is classification based on controllability. This classification is based on whether or not a cost can be influenced by a particular level of management. Controllable costs are those that a manager can influence or regulate through their actions. For example, a department manager can control how much is spent on travel or overtime wages. Uncontrollable costs are outside the scope of manager's control. These could include fixed costs like factory rent, property tax, or utility tariffs decided by external authorities. Now, why this cost classification is important? Classifying cost correctly allows managers to control spending, set accurate product prices, and make informed decisions. It helps in budgeting, performance evaluation, cost control, and profitability analysis. For example, by knowing which costs are fixed and which are variable, businesses can forecast profits at different levels of sales and avoid financial surprises. Thank you so much. I hope you like the lecture. If you like the lecture, then please like, subscribe and share Tecnia TV.